Valuation is probably an area where the most investors fight to determine what is the good valuation for stocks that you want to buy. So in this video, I will explain you and show you my DCF valuation, the one that I'm using. So it's not mine, I didn't invent it, but it's the one that I'm using. I find it very efficient. So I will show you all the exact steps to use to do it by yourself, okay? A little disclaimer, a valuation is always something approximate. Okay, you will have some gross approximation and so on. So you cannot rely 100% on it. You need to understand the business and not only focus on valuation to invest. There is a lot of people that do this mistake that, okay, it's undervalued, so I buy. No, you need to understand the business and you need to invest in great company. And last one, I mainly use it to avoid paying too much for stock rather than trying to find a good price or a big undervalued company. What do you need to do this DCF valuation? First, you will need a valuation multiple. So it will be P ratio, price to free cash flow, price to operating cash flow, price to sale, whatever one you're comfortable with. And it's also depend from a company. For example, you will use P ratio for most of the companies. Sometimes you will use price to operating cash flow with some business because they invest a lot in CapEx. So maybe operating cash flow will be more representative. But that's the one that I'm using. Then you will need the dividend, if a dividend is paid, obviously. The gross estimate, so gross of net income. So if you will here select PE ratio, you will use net income. If you use price to operating cash flow, you will use operating cash flow here. You want as well the gross estimate for the dividend, the revenue. You will need a discount rate. So it's the annual performance that you're aiming for when you buy a company for your stock. Generally, the market is aiming for 10%. I personally use 13% to have extra margin of safety on it. Also, you will need the number of shares outstanding, the number of years that you will want to do your DCF projection, 3, 5, 7, 10, that's the most common one. I personally use 5 most of the time, okay, sometimes 3, sometimes 10, but most of the time I go with 5. And then you need the share price, the actual share price, which is something important. So step number 1, first you will estimate a future growth, okay? So for example, you have a net income on 2.9 billion. You estimate that the company will grow by 10% per year for the next 5 years. How do you determine this 10%? Okay, you have 2 options. You can have a look at the past performance. So you can have a look at the last 20 years, the last 10 years, and it will show you, okay, during the last 10 years, the company grew by 10% per year. So you can say, okay, it grew by 10% per year for the last 10 years. So maybe for the next 10 years, it will grow as well by 10% per year. I don't really like this one because you have different cycles in business, and you have some companies that are in cycle where they are hyper scaling, that are growing extremely fast, and some cycle where they are already well implanted on the market, so they don't have that much growth that they can get. So sometimes getting the past performance is not really good. For very old company, okay, for company with more than 30 years of track record, this can be useful, especially if you look at the 20 years average and so on, because they had already some bad moment, some difficult time. They probably had some moment where growth were not really here. So you can have an approximation with this. The second technique is to use what analysts think. So it's not basing your thing on analysts, but let's say for the next 5 years, the estimate from the analyst are plus 15% per year for the net income. So you can imagine that 15% will be approximately accurate, okay? Especially if you already did your due diligence for the business, you understand the number, you understand the business, and you're like, yeah, okay, 15% for this business seems to be fair. And on this, I will always personally take at least 20% off, especially when the market are pricing a lot of growth, okay? When the market are very expensive, I will take out at least 20% of this to have my estimate growth for the company. So I will use those 2 ways to kind of try to estimate what the growth can be for the future. So here we'll take 10% for the next 5 years. So it's 5 years, net income will be, so this is the formula, it's actual net income times 1 plus growth rate exponent number of years. Okay, so you will have 2.965 billion. You multiply it by 1 plus 0.10, so 10%, exponent 5, so you will have 4.775 billion. Okay, when you have this 4.775 billion, you can go to step 2. Step 2 will be to estimate the future shares outstanding. Okay, so for example, you have 1.265 billion shares for the company, and let's say here they don't do buybacks. Okay, here let's say they have more shares outstanding every year, so you will have plus 0.5%. So you will do share outstanding, the same formula, so actual share outstanding, you multiply it by 1 plus 0.005, so 0.5%, exponent 5, and you will have 1.292 billion share outstanding. If it was, I don't know, if it was here, minus 1% per year, like every year they do 1% buyback, here instead of plus, you will have a minus, and you will have minus 0.01, etc. Okay, you understand this? So here you have the number of shares. When you have your future number of shares outstanding, you can go to step 3. Step 3 will be to estimate the future dividend, if there is a dividend, plus how much in dividend you will receive in your pocket during those 5 years, because it needs to count. It's money that you will receive, so it needs to count. So you need to take into consideration the dividend you get every year, so the formula here will be a bit different. For example, your actual dividend is $3.32. The growth rate is 10% per year, and the formula with a constant growth rate. Like here you estimate that for the next 5 years, it will always be 10% per year. Maybe some year it will be 12, maybe 8 after 8, but you just imagine that, okay, for the next 5 years, it will be 10% per year. So the formula will be actual dividend, multiply by 1 minus growth rate, exponent number of years, and then you will divide by 0.10, so by the growth rate. Okay, so you will have 3.32 multiplied by 1 minus 0.10, exponent 5 minus 1, and divided by 0.10. It will be equal here at 20.27. So I forgot the minus 1 right here. Up. So you need to add this, and this $20 will be the amount you will receive in dividend during those 5 years. Another technique here that you use the previous formula that you have here, but you do it for each year. So for 5 years, you will need to do this 5 times. Like this, maybe you will be able to use different growth rate every year, and then you sum everything, and you will have the amount of dividend that you will have. When you have this, you go to step 4, which is determining the future price estimate. Okay, so the formula for future price estimate is earning estimate divided by share outstanding estimates multiplied by the P ratio projection plus dividend. So it's a P ratio projection. It can as well be the price to operating cash flow, price to free cash flow, etc. Okay, so when you have all of this, you can do it. For the example we had in the beginning, we'll take a P ratio of 30. So we will take the earning estimate, we have it here, it was step 1. So we'll take 4.7 billion divided by the number of shares outstanding, 1.29 billion. Then we'll multiply it by 30 because we have an estimation that the P in 5 years will be 30. And to this, we will add at the end the dividend that we received. So it gives us a price in 5 years that will be $131.08. Okay? Now when you have this, you can go to step 5, get the cumulative annual growth rate. Okay? You have the share price now. You want to know if the share price is this now and it will be this in 5 years, how much percentage per year I'm making on it. So the formula is simple. It's final price divided by initial price, exponent 1 divided by the number of years of the projection minus 1. So example, you have the final price, which is 131. The actual price of the company is $72, and exponent 1 divided by 5, because you want a 5-year projection, minus 1, it gives you 12.73%. So it means that if you invest at $72 and all those projections, the growth rate projections that you had and so on are right, you will eventually make 12.73% per year for the next 5 years. Now, again, as I told you, it's not certain, it's not sure, it's just an evaluation, it's just something that, yeah, like this, you know that, okay, at this price, I have the potential to make this per year, so you know that you may be undervalued, because if it will show, I don't know, 2% per year, you will say, okay, here there is not a big growth possible here, so I will pass my turn. Here, you have an idea what you can do and you can determine if it's too expensive or not. A little bonus step is to know the right price to buy. Like you have this estimation, but you want to know, okay, at which price I need to buy. So for this, you will need the discount rate that we saw here. So the discount rate is the annual performance you're aiming for, okay? The formula is future price, so 131 here, divided by 1 plus the discount rate, exponent number of years. So we want a 13% discount rate. I'm using 13% because like this I have a kind of big margin of safety. The market generally is aiming for 10%, so that's why I prefer to use 13%. So the fair value will be 131.08 divided by 1 plus 0.13, exponent 5, okay, because it's the number of years, which is equal to $71.14. So it means that if you want to do 13% with this company, you will need to buy at $71.14. So now we're at 72. We can estimate that it's approximately around the fair value. So this is the steps that you want to do. You can use it in a Google Sheet or something like this to go faster. It's the valuation model that I use in Margin app, okay, in the app that I'm developing, and it is launching soon. That, by the way, you can join the waitlist to be one of the first to be able to use the app and to have a big discount code for the first launch. We'll open only for 20 people. This is the model that we use here to evaluate the fair price. So as you can see here, I use the data from Arista Network, okay? I use data from Arista Network to do it. So the price now is 78. It was 72 when I wrote this down. So it's all here, and you can see that the fair price will be around $62 for this company if we estimate 14% growth rate with 0.5% dilution per share for shareholder every year. We want a P ratio of 26 in 5 years, and we have a discount rate of 13. So the fair value will be 62. If we buy at this price, we'll have 7.92%. It excludes the dividend because there is no dividend for the company right now. So let me know what you think about this video in the comment section. If you have any question or anything, just let me know in the comment section, and start joining the waitlist for Margin. We are launching very soon. So see you in the next video. Bye.